All right, welcome back. Let's jump right in, because today we're talking about something you probably think you know, the index fund, or ETF. The standard advice says it's the safe, smart, set it and forget it choice. But what if that's only half the story? What if it's actually a powerhouse tool for a much more active game? Now get a load of this quote. It just flips everything we've been told right on its head. The riskiest investments in the world? He's talking about a diversified portfolio, the very thing your financial advisor has probably been telling you to do for years. How can that possibly be risky? It's a huge statement, so let's see what's behind it. So here's the core idea: systemic risk. We're always told, don't put all your eggs in one basket, right? So you buy a whole bunch of different stocks. The problem is that logic totally breaks down when the entire basket, the whole market, plunges. In 2008, it didn't matter how diversified you were, because your diversified portfolio just meant you owned a tiny piece of everything that was crashing. So this leads us to a really, really important question. If the so-called safest way to invest still leaves you vulnerable to things you can't control, then what's the move? How do you stop being just a passenger hoping for the best and actually get behind the wheel yourself? Well, let's talk about the tool that can help you do just that, the exchange-traded fund, the ETF. But we're not going to look at it as just a simple passive investment. We're going to see it as a dynamic part of an active investor's toolkit. Okay, so what is it? Let's make it super simple. An ETF is basically a shopping basket. But instead of groceries, it's filled with hundreds or even thousands of stocks or bonds. And here's the really cool part. You can buy or sell that entire basket on the stock market in one shot, just as easily as buying a single share of Amazon. And this table here shows you exactly how it works. You want to invest in the 500 biggest companies in the US. Instead of buying 500 different stocks, which would be a huge pain, you just buy one share of the ETF with the ticker SPY. Bam! You instantly own a piece of the whole S&P 500. And as you can see, they've got them for all the big indexes. It's incredibly efficient. But here's where we make a huge pivot, because being efficient is great. But for an active investor, these ETFs are like a Swiss Army knife. They unlock a ton of strategies that go way, way beyond just buying and hoping it goes up. First, you have to get this fundamental mind shift. Most people invest for capital gains. That means they buy low and pray the price goes up so they can sell high. The problem? You have zero control over that. A much more powerful way to think is investing for cash flow, making your assets generate regular income no matter what the price is doing. Now that is something you can control. And believe me, this isn't just some textbook theory. The source material tells this incredible story of an investor who did exactly this. They used the S&P 500 ETF, SPY, and cranked out almost $10,000 in income in 1 year. Get this, while the price of SPY was actually going down. How is that even possible? Well, the analogy they use is perfect. Imagine you own a rental property. Even if the real estate market is down and your house is technically worth less, who cares? You're still collecting that rent check every single month. It's the exact same idea here. You can essentially rent out your ETF shares using strategies like covered calls and just generate consistent income month after month. And generating that cash flow is just one tool in the toolbox. Active investors also use ETFs for something called sector rotation, which is basically placing smart bets on the hottest parts of the economy. And they use them for hedging, which is a fancy word for buying insurance in case the market takes a nosedive. So, sector rotation sounds complicated, but it's not. It's a top-down look. First, you just ask, is the whole market going up or down? Is the tide coming in or out? Then, you look for the strongest currents. Where's the big money flowing? Is it into energy, into tech? You figure that out, and then you just find the right ETF to ride that wave. And it's so easy to do because pretty much every major sector has its own ETF. You think energy is about to boom? There's XLE. You think tech's the future? XLK. This gives you laser-like focus to target specific parts of the economy without having to become an expert on 100 different companies. Okay, but what about the scary times? What do you do when you think the whole market is about to drop? Well, this is where hedging comes in. An active investor doesn't just sit there and watch their money disappear. No way. They use specific tools to protect their portfolio, just like you buy insurance for your house. And one of the coolest tools for this is the inverse ETF. I love this. So the ETF that tracks the Dow Jones is called Diamonds, and its ticker is DIA. But there's another ETF with the genius ticker, DOG, and it is designed to do the exact opposite of the Dow. So if the Dow falls by 1%, DOG goes up by 1%. You can literally make money when the market is crashing. You see, all these strategies, generating cash flow, rotating sectors, hedging,
They all come back to one central idea. It's all about a mindset of taking total control of your money.
This quote really just says it all, doesn't it? Seriously, think about it. Who cares more about your money than you do? Nobody. Taking responsibility for your own financial future isn't some chore. It's an incredible opportunity. You are the one in the driver's seat.
And it's all about focusing on what you can control versus what you can't. You can't control which way the market is going to go tomorrow. Nobody can. But you 100% control whether you're just going to sit in a 401k and watch it get wiped out, or if you're going to use the tools available to navigate the chaos and maybe even profit from it.
So the real takeaway here is that we're not just talking about different strategies. We're talking about two completely different games, and every single investor has to decide which one they're playing. You know, on one side, you've got the person who buys a pre-made package, hands their money over, and just hopes, crosses their fingers and hopes it all works out. And on the other side, you have the person who takes the time to learn the rules of the game so they can actively manage their money and create their own results. And that brings us to the final question I want to leave you with. Your typical, safe, diversified portfolio, it's designed to play not to lose. But all the strategies we just talked about, that's about playing to win. So you have to ask yourself, which game do you want to be in?